Topic explains that Basel III reforms were introduced in response to weaknesses exposed during the global financial crisis of 2007 to 2009. The crisis revealed that many financial institutions maintained insufficient capital, excessive leverage, and inadequate liquidity despite appearing compliant with earlier regulatory frameworks. Basel III was therefore designed to strengthen the resilience of banks and reduce systemic risk within the global financial system. The reforms focus on improving the quality and quantity of capital, enhancing liquidity management, limiting excessive leverage, and strengthening risk governance. Basel III also emphasizes forward-looking supervision and stress testing to ensure that financial institutions remain capable of absorbing losses during severe economic and financial disruptions. One of the central components of Basel III is the strengthening of regulatory capital standards. Regulators increase the importance of Common Equity Tier 1, CET1, capital because it provides the highest quality loss-absorbing protection. Basel III raised minimum CET1 requirements and introduced stricter definitions of eligible capital instruments to improve transparency and reliability. Additional capital conservation buffers were also implemented to ensure banks maintain extra capital during normal economic periods that can be used during financial stress. Counter-cyclical capital buffers further require institutions to accumulate additional capital during periods of excessive credit growth. These measures reduce procyclicality and strengthen banking sector stability across changing economic environments. Basel III also introduced leverage and liquidity reforms designed to address vulnerabilities that were not adequately captured under previous regulatory frameworks. The leverage ratio serves as a non-risk-based measure limiting excessive borrowing and balance sheet expansion by financial institutions. This simple ratio complements risk-weighted capital measures by preventing institutions from accumulating excessive leverage through low-risk-weighted assets. Liquidity risk management became another major focus because many institutions experienced severe funding shortages during the financial crisis. Basel III therefore introduced the Liquidity Coverage Ratio, LCR, and Net Stable Funding Ratio, NSFR, requiring banks to maintain sufficient high-quality liquid assets and stable funding sources to survive stressed market conditions. The Basel III framework significantly expanded the use of stress testing, supervisory oversight, and risk governance requirements. Regulators now expect institutions to conduct forward-looking stress testing exercises assessing how adverse economic scenarios could affect capital adequacy, liquidity positions, profitability, and operational resilience. Governance standards require boards of directors and senior management to take active responsibility for risk management, capital planning, and strategic oversight. Basel III also strengthened risk coverage for trading activities, securitization exposures, derivatives, and counterparty credit risk. These reforms encourage institutions to integrate enterprise risk management practices more effectively while improving transparency, accountability, and operational resilience across increasingly interconnected global financial markets. Overall, Basel III reforms represent a comprehensive effort to improve the stability, transparency, and resilience of the international banking system. By strengthening capital quality, enhancing liquidity management, limiting leverage, and promoting stronger governance, Basel III seeks to reduce the probability and severity of future financial crises. Although implementation of the reforms has increased compliance costs and reduced some short-term profitability for banks, the framework supports long-term financial stability and market confidence. Financial institutions continue adapting their business models, capital structures, and risk management practices to align with Basel III requirements. Ultimately, the reforms have reshaped modern banking regulation by emphasizing resilience, prudent risk-taking, and sustainable financial performance.